I could save time in a bottle, the first thing that I'd like to do is to save every day till eternity passes away, just to spend them with you. If I could make days last forever, if words could make wishes.
Okay. Driven by the procedures and cycle of the organization's financial reporting system, management accounting information is produced too late, too aggregated, and too distorted to be relevant for managers' planning and control decisions. With increased emphasis on meeting a quarterly or annual earning targets, Internet accounting system focus too narrowly on producing a monthly earning reports. And despite the considerable resources devoted to computing a monthly or quarterly income figure, this figure fails to measure the actual increase or decrease in economic value that has occurred during this period. Management accounting reports are of a little help to operating managers attempting to reduce costs and improve productivity. Frequently, the reports decrease productivity because they acquire operating managers to spend time trying to understand and explain reported variants that have a little to do with the economic and technological reality of their operations. The management accounting system fails to provide accurate product costs. Costs get distributed to products by simplistic measures, usually direct labor-based, that do not represent the demands made by each product on the firm's resources. There could be many valid short-term measures that would be appropriate for motivating and evaluating managerial performance. It is unlikely, however, that monthly or quarterly profits, especially when based on the practice's mandate and used for external constituencies, would be one of these. To this, management accounting systems provide a misleading target for managerial intentions. They fail to provide the relevant set of measures that appropriately reflect the technology, products, processes, and competitive environment. Financial managers relying exclusively on periodic financial statements for their view of the firm get isolated from the real value-creating operations of the account organizations and fail to recognize the operation when the accounting numbers are no longer providing relevant or appropriate measures of the organization's operation.
An organization management accounting system must provide timely and accurate information to facilitate efforts to control costs, to measure and improve productivity, and to devise improved production processes. The management accounting system also needs to report accurate product costs so that pricing decision, introduction of new product, abandonment of obsolete product, responses to appearance of rival product can be made with the best possible information on product resource demands. This system should provide appropriate incentive and signal to managers working in different functions with diverse products and processes amid globally dispersed operations. The organization management accounting system serves as a vital two-way communication link between senior and subordinate managers. It is means by which senior executive communication to subordinate and decentralized managers the goals and objectives of the organization. In the reverse direction, the management accounting system is channeled by which information about the firm product performance and production efficiencies get reported to upper levels of management. Further, managerial compensation and promotion decisions are usually based on the numbers reported by management accounting system. An excellent management accounting system will not by itself guarantee success in today's economy. Ultimately, success depends on products that meet customer needs, on efficient production and distribution system for these products, and on effective marketing efforts. With an effective management accounting system, the best outcome occurs when the managers understand the irrelevance of their system and bypass it by developing personalized information system. But danger lies if managers do not recognize inadequacies in their management accounting system and erroneously rely on it for managerial control information and product decision.
Fortunately, the increased demands for excellent management accounting system occur at a time when the costs for collecting, processing, analyzing, and reporting information have been decreasing. With many production process under direct control of digital computers, information can be recorded in real time for analysis of operating performance. In highly automated environments, virtually every transaction can be captured for subsequent analysis. Automated parts recognition and tracking systems combined with local area network technology can provide continual status reports on work in process. Thus, extensive systems now can accurately measure and attribute the resource demands made by each product in a diverse product line. Timely and relevant managerial performance measures can be computed and disseminated throughout the organization. Today's designers of management accounting systems can use sophisticated electronic technology to devise reporting and control systems that are more accurate, more timely, and hence more effective than those designed by their predecessors. Simplified and aggregate procedures that were adopted in earlier decades because more relevant and timely procedures would have been too costly or even infeasible no longer need to be tolerated. The computing revolution of the past 2 decades has so reduced information collection and processing costs that it has removed virtually all barriers to the design and implementation of effective management accounting systems.
Historians have demonstrated that accounting reports have been prepared for thousands of years. Bookkeeping records dating back to ancient civilizations have been found engraved in stone tablets. 500 years ago, a Venetian monk, Fra Pacioli, described the basics of a well-functioning double-entry bookkeeping system. Thus, the demand to record information on commercial transactions has existed for as long as people traded with each other in market exchanges. But the demand for management accounting information about transactions occurring within organizations is a much more recent phenomenon. Before the early 19th century, virtually all exchange transactions occurred between an owner/entrepreneur and individuals who were not part of the organization, raw material suppliers, labor paid by piecework, and customers. There were no levels of management, nor were there long-term salaried employees of the organization. Transactions occurred in market and measures of success were easily obtained. The owner-entrepreneur needed to collect more cash from sales to customers, then was paid out to suppliers of the input factors of production, primarily labor and material. As a consequence of the Industrial Revolution and the ability to achieve gain through economies of scale, it became efficient for 19th century enterprise owners to commit significant sums of capital to their production processes. In order to gain maximum efficiency from their capital investment, owners hired workers on a long-term basis rather than bearing the cost and risk of continual spot contracting in the labor market. The long-term viability and success of these managed organizations revealed the gains that could be earned by managing hierarchical organizations, as opposed to conducting all business through market transactions. Examples of such successful hierarchical organizations are the textile mills founded in the first half of the 19th century, the railroads formed around mid-century, and the steel companies created in the second half of that century. The emergence more than 150 years ago of managed hierarchical organizations created a new demand for accounting information, as conversion processes which formerly were supplied at a price through market exchanges became performed within organizations. A demand arose for measures to determine the price of output from internal operations, lacking price information on the conversion processes occurring within their organizations. owners devised measures to summarize the efficiency by which labor and material were converted to finished products. These measures are also served to motivate and evaluate the managers who supervised the conversion process. Such measures were especially important because frequently the factories were located a considerable distance away from the central office of the owners. Thus, management accounting developed to support the profit-seeking activities of entrepreneurs for whom multi-process, hierarchical, managed enterprises were more efficient than managing conversion processes through continual transactions in the marketplace. The early management accounting measures were simple but seemed to serve well the needs of the owners and managers. They focus on conversion costs and produce summary measures such as cost per hour or cost per pound produced for each process and for each worker. The measured costs included labor and material and involved some attribution of overhead costs. The goal of this system was to identify the cost for the intermediate and final products of the firm and to provide a benchmark to measure the efficiency of the conversion process. In addition, the management accounting information provided a substitute or a surrogate for the market prices that were absent in managed enterprises.
By 1925, virtually all management accounting practices that are practiced today had been developed. Cost accounts for labor, material and overhead, budget for cash, income and capital, flexible budgets, sale forecasts, standard costs, variance analysis, stamp transfer price, and divisional performance measures. These practices had evolved to serve the informational and control needs of the managers of increasingly complex and diverse organizations, but the pace of innovation seems to stop in the mid-1920s. Perhaps sense. For instance, knowledge about the historic conditions that prompted manufacturing managers to account for unit direct labor, cost of products may help us evaluate the relevance of that type of accounting information under present-day conditions. If the technological and market condition no longer exist that made managing direct labor a strategic source of profits, then perhaps it is time to create new information that is more relevant to new strategies. Understanding their root will help management accountants consider carefully the conditions that make particular systems relevant. Each organization has to decide for itself those measures that will promote its tactical and strategic goals. It is unlikely that monthly income will be one of these measures. Organizations stressing total quality control and zero defect policies will want to measure yields, the incidence of failures internal and external to the organization. For audited periodic financial statements may have been the correct economic decisions. The benefits from a more accurate and more responsive management accounting system may not have been worth the cost of maintaining such a separate systems. Over the years, however, as corporations, product lines expanded, as production technology changed, as product life cycles shortened, as global competitive conditions shifted, and most importantly, as great advances in information technology occurred, we should have expected a reconsideration of the decision to not invest in a more relevant and more timely management accounting system. But by the time these events unfolded, the spirit and knowledge of management accounting systems designs that occurred throughout the 100-year, which is 125 years to 1925 years period, had disappeared. In fact, when cost systems become automated on digital computers starting in the mid-1960s, the system designers basically automated the manual system they found in the factory. Left unquestioned was whether the system was still sensible given the great expansion in information technology represented by electronic digital computers.
We believe academics will lead astray by focusing too narrowly on a simplified model of firm behavior, influenced strongly by economists. One production process model of the first management accounting academics found the little value in the cost allocation imposed on all organization by financial accounting procedure. This literature, very persuasive when illustrated in the simple one product settings used by academic economists and accountants, never fully addresses the question of where fixed costs came from and how these costs needed to be covered by each the product in the corporation. Nor did the academic researcher attempt to implement their ideas in their environment of actual organization with hundreds or thousands of products and with complex multi-stage production processes. Thus, the academic literature concentrated on elegant and sophisticated approaches to analyzing costs for single product, single processes firms, while companies try to manage with antiquated system in settings that have little relationship to the simplified model assumed for analytical convenience by researchers. Ironically, as management accounting systems become less relevant and less representative of the organization's operation and strategy, many companies become denominated by senior executives who believe that they could run by the firm by the numbers. Early 20th century organizations such as DuPont, General Motors, and General Electric has been created by owners who well understood the technology of their products, processes. In succeeding decades, however, chief executives were selected whose entire careers were spent in staff functions, such as finance and legal. Lacking knowledge and uncomfortable with their firm's underlying technologies, these CEOs increasingly look at the project short-term impact would be on financial measures when making decisions, especially earnings per share and return on investment. But as a product life cycle are shortened and more costs are incurred before production begins, R&D, product and process design, capital investment, software development, and education training also. Directly traceable product costs become much lower fraction of a total cost. Consequently, traditional financial measures such as periodic earnings and accounting ROI become less useful measure of a corporate performance.
In some respect, this is not a new phenomenon. If we return to the 15th century and the publication of perhaps the original book by Fra Pacioli, we can ask what kinds of events were occurring that led to a demand for accounting information. Undoubtedly, merchants in Venice were trading goods with other countries. Consider a group of Venetian investors who acquired goods produced in northern Italy and chartered an expedition to sell these goods in India. Arguing that it is meaningless to allocate project profitability to short time periods within the life of a project does not imply that we believe it is fruitless to attempt to obtain valuable indicators of short-term progress. Returning to our Venetian expedition, there probably are many measures of the caravan's performance during the third quarter of 1487 that the investor would be interested in knowing. For example, what distance did the caravan cover and in what direction? How many provisions are left? What is the condition of the inventory being transported? Are the workers content or rebellious? There are many potentially useful indicators of the caravan's manager's performance during the third quarter 1487. But quarterly profit is not one of them. Certainly, cash flow is important that we would want to know the pattern and structure of a company's cash receipts and cash expenditures. But knowing the sources and the use of cash is very different from working hard every month and every quarter to produce complete income statement and balance sheets, replete with amortizations, capitalizations, and many other accruals.
The challenge and opportunity for contemporary organizations is clear. Management accounting systems can and should be designed to support the operations and the strategy of the organization. The technology exists to implement systems radically different from those being used today. What is lacking is knowledge, but this knowledge can emerge from experimentation and communication. The innovative spirit of 100 years ago at the outset of the scientific management movement can be recaptured by creative managers and academic researchers who are committed to developing the new concepts for redesigning relevant management accounting systems.